Welcome to Iron Financial, the show where we forge stronger portfolios by cutting right through the market weakness. Today, we are putting on our hard hats and grabbing our blueprints to inspect the framework of Target Hospitality, ticker symbol TH. Now, their latest earnings report just dropped, and folks, it is a real head-scratcher. It's a total paradox. The company posted a pretty significant loss, a big one, yet the stock surged. Now, that's a signal that tells you Wall Street is completely split down the middle on this thing. So we're going to dig into the numbers, we're going to stress test the foundation, and we are going to figure out if this company is a skyscraper in the making or if it's just a house of cards on the verge of collapse. Let's get to work.
All right, to get this done right, we are going to run a full structural inspection, top to bottom. First, we'll start by decoding the market's completely conflicting signals, why a loss looks like a win to some people. Then, we're going to get our hands dirty. We're going to unpack the damage from 2025 to find the real source of the problem. After that, we'll examine the blueprints for their massive, and I mean massive, pivot to power and AI. And finally, we'll stress test the actual financial foundation of this company and deliver our final ironclad verdict. This is a complete top-to-bottom analysis, so let's get into it.
All right, let's just get right to the core problem here, the big question hanging over everything. On paper, this report looks ugly. I mean, really ugly. Target Hospitality missed earnings estimates, and they booked a substantial net loss for the entire year. Now, any rational investor sees that much red ink on a page and they head for the exit, right? But the market did the exact opposite. It bid the stock up more than 6% before the opening bell even rang. So what on earth is going on here? Is the market completely unhinged? Has everyone lost their minds? Or is it seeing a blueprint for the future that these headline numbers are designed to hide?
Okay, let's put these numbers side by side because this is where the story really gets interesting. You just have to see it to believe it. On one hand, you've got a 15-cent earnings miss in the fourth quarter, and then a full-year loss of $37 million. That's a sea of red ink. Think about it. That's a massive swing from a $71 million profit just the year before. That's a $100 million turnaround in the wrong direction. But then you look at the other side of the ledger. Revenue in Q4 actually beat expectations, and the stock pops. The market is absolutely screaming that it sees something the bottom line isn't telling us. It's looking right past the wreckage of 2025, and it's betting on the reconstruction. Our job today is to find out if that's a smart bet or a fool's errand.
So this is the conflict in a nutshell, right? You have a past performance that looks like a five-alarm fire, just total chaos. And then you have a market reaction that suggests a billion-dollar opportunity is just waiting around the corner. To understand what's really happening with Target Hospitality, you have to realize a critical point. The market isn't trading on 2025's numbers. It's not even looking at them. It's trading on 2027 and beyond. Whoa, hold on. I have to call a spade here. This feels like pure, unadulterated hype. A $37 million loss isn't a rounding error. That is a gaping hole in the hull of the ship. The market can price in whatever story it wants, but right now, in the here and now, this company is not profitable, period. A revenue beat is nice, sure, but it doesn't pay the bills. I'm going to need to see a lot more than just a story stock narrative. Show me the steel. Show me the proof that this isn't just a speculative gamble that could completely collapse on itself.
You know what? You're right to be skeptical, and you're absolutely right that we can't just ignore the past. But let me ask you this. What if the collapse wasn't an accident? What if it was a controlled demolition? Before we can possibly look at the new blueprints, we have to inspect the old foundation and understand precisely why it was torn down in the first place. So let's unpack the damage from 2025 and see if we can find the detonator.
Okay, now, what's really striking when you look at this slide is the sheer velocity of the decline. This is not a slow leak, folks. This is a catastrophic failure of the old business model. Revenue dropped by over $65 million. Net income, well, it just evaporated, swinging over $100 million from a healthy profit into a significant loss. But the number here that should get every single investor's attention is that adjusted EBITDA. It cratered from nearly $197 million all the way down to just $53 million. That is a 73% collapse in operating profitability. You do not see numbers like this unless something fundamental, something at the very core of the business, has broken.
Exactly. A 73% drop isn't a crack in the foundation. It's a sinkhole that swallowed the entire 2024 profit structure whole. This demands a clear, unambiguous explanation. This wasn't a bad quarter or a tough economic cycle. This was a specific, catastrophic event. So what happened? What was the single point of failure that caused this entire financial model to just implode on itself? Don't tell me about headwinds. Show me the cause.
And there it is. The smoking gun.
The entire financial implosion can be traced back to one single event, the company losing its Pecos Children's Center, or PCC, government contract. For years, this thing was their cash cow. It was a massive, high-margin contract that was the bedrock of their profitability. But here's the crucial point that changes everything. The market knew this was coming. This was not a surprise. You could almost call it a deliberate demolition. The company tore down its most profitable, yet also its most vulnerable pillar, in order to rebuild something bigger and stronger. The 2025 numbers we're looking at, they're simply the dust settling from that controlled explosion. And this chart, wow, this chart just brilliantly illustrates the sheer force of that explosion. Just look at the government segment revenue in the fourth quarter alone. In 2024, it was nearly $44 million. A year later, with that PCC contract on, it was down to under $14 million. That is a $30 million hole in a single quarter from just one business segment. This is why profitability fell off a cliff. So the question isn't, why did the old building fall? The real question is, what are they building in its place, and is it strong enough to stand on its own?
And that question takes us straight to the bull case, the pivot to power. The 2025 numbers show us the demolition. Now we get to look at the blueprints for the brand new structure. The market ignored the loss because, let's be honest, the PCC contract was old news. The market is always forward-looking, and it was laser-focused on the new steel framework the company is bolting together. A strategic pivot away from that one single government contract and directly into the heart of America's infrastructure supercycle.
And this is the number that tells the entire story, $740 million. Let that sink in. That is the total value of new, multi-year contracts that Target Hospitality has locked down since February 2025, the very month the old PCC contract died. They didn't just patch the hole, they started laying the foundation for a structure that is orders of magnitude larger and, more importantly, more diversified. This number, $740 million, is the entire bull thesis. It's why the market shrugged off a $37 million loss and sent the stock screaming higher. It represents a complete and total transformation of the business.
So let's actually look at the blueprints. This isn't just one contract replacing another. This is an entire portfolio aimed squarely at the future. Look at the themes here because they matter. First, you have the AI and data center boom. $129 million for a power community in West Texas supporting data centers, plus another $134 million for more AI infrastructure. That is over $250 million tied directly to the AI gold rush. Next, critical minerals and domestic supply chains, a $175 million hub for that. Then you have power generation, projects in both Texas and Nevada. They are positioning themselves as the go-to premier provider of workforce housing for the very people building America's future. And you know what? They haven't abandoned their old business either. They secured a new $246 million government contract, proving they can still compete in that space. But now, it's just one strong pillar among many.
And the CEO, Brad Archer, he lays it out right here in black and white. This isn't luck, it's a calculated, deliberate strategy. He says their momentum reflects a historic investment cycle. They see the trillions of dollars flooding into building new data centers, reshoring manufacturing, and upgrading our power grid, and they are positioning Target Hospitality as an absolutely essential service provider for that boom. This confirms the pivot is a deliberate, top-down plan to ride a massive secular tailwind for the next decade, if not longer. Okay, I'll concede that a $740 million contract pipeline is a powerful new frame. It's impressive. But a skyscraper is more than just steel beams, right? It needs a bedrock financial foundation to support all that weight. A huge revenue backlog is great, but if the company is drowning in debt or burning through cash just to service these new projects, the whole thing could come crashing down before they even cut the ribbon. It's time to get out the level and inspect that foundation for any hidden cracks.
And this, right here, is where the bull case goes from just interesting to downright compelling. The foundation, it appears to be made of granite. Let's run the numbers. As of the end of the year, the company had zero net debt. Let me repeat that, because in this market, that's almost unheard of. Zero net debt. They are sitting on a cool $183 million in total liquidity. Their debt-to-equity ratio is basically a rounding error at 0.03. And for the real gearheads out there, the Altman Z-score, which is a key predictor of bankruptcy risk, is a stunning 4.86. For context, anything over 3 is considered safe. A score of 4.86 puts them in the fortress category. They have the financial firepower to fund this entire transition without taking on toxic debt or diluting shareholders into oblivion. This foundation is absolutely built to handle the heavy lifting.
So let's put the two sides head to head. The bull case is incredibly powerful. A fortress balance sheet funding a $740 million pivot directly into the AI and infrastructure boom. It's a fantastic story of a well-funded strategic turnaround. But the bear case on the right is just as real, and we have to look at it. If the future is so bright, why did insiders dump over 22,000 shares recently? That's a huge red flag for me. The PE ratio is negative because, as we established, the company isn't profitable right now. And maybe the biggest risk of all is execution. Announcing a contract is the easy part. Building it out, on time, on budget, and, most importantly, profitably, well, that's a different beast entirely. These are complex projects, and a whole lot can go wrong.
And this chart right here proves my point about that execution risk. Wall Street is not singing kumbaya about this company. You have Stifel pounding the table with a buy rating and an $11 price target. Clearly, they're fully bought into the AI growth story. But right next to them, you have Texas Capital initiating with a hold and a $9 target. They're obviously worried about the valuation and the challenges that lie ahead. When the professionals are this divided, it tells you there is significant material uncertainty about whether this company can actually deliver on its grand vision and turn all that new revenue into real, sustainable profit.
And that uncertainty? That is the key. The risks of insider selling, poor execution, and that margin pressure we keep talking about are very real threats to this bull story. But let's be fair, every major construction project involves risk. Now it's time to weigh all the evidence, the demolition of the past, the blueprint for the future, and the strength of the foundation, and deliver the final iron financial verdict. So, when you boil it all down, the entire narrative comes down to these three simple steps. First, the past. A controlled demolition of a single, highly profitable but dangerously concentrated revenue stream. That's done. Second, the present. A strategic pivot, leveraging a pristine balance sheet to build a new, diversified portfolio tied directly to the biggest investment cycle of our generation. That's happening now. And third, the future. This is the chapter that's still unwritten. It all, and I mean all of it, comes down to execution. They have to prove they can manage these new, complex projects and deliver the profits the market is already pricing in. And the company's own guidance for 2026 shows just how tough that execution is going to be. You have to look closely at these numbers. Revenue is guided to be between $320 and $330 million. That's basically flat compared to 2025. But look at the adjusted EBITDA, $60 to $70 million. Now, while that's an improvement over the $53 million they just posted in 2025, it is a universe away from the nearly $200 million they generated back in 2024. This guidance is a clear signal from management themselves that the margin compression from this transition is real, and it is severe. The heavy costs of building and ramping up all these new facilities means the profit payoff is absolutely not going to be immediate. So, here it is. Here is our verdict. Target Hospitality is a high-risk, high-reward construction project in the most literal sense of the term. Management has bravely torn down an old, stable, but ultimately limited structure. In its place, they've laid a rock-solid foundation and are now erecting the steel frame for something much larger, more modern, and with a panoramic view of the AI and infrastructure boom. However, and this is a big however, the project is only half built. The construction phase is fraught with execution risk, the costs are high right now, and there is absolutely no guarantee the final structure will be as profitable as the blueprints suggest.
Okay, let's just boil this down to the key takeaways for you. First, you have to understand that the market is completely ignoring the 2025 loss. It's betting entirely on the successful execution of that $740 million pivot. Second, the bull case is anchored by that fortress balance sheet, which gives them the time and the money to finish the job. But third, and most critically, the entire investment thesis now hinges on execution and margins. The guidance proves this is a real challenge. The ultimate proof in the pudding will be seeing if and when they can convert these new contracts into high-margin recurring revenue. That is the only metric that matters from here on out.
And that leaves us with the final question, the one you have to answer for your own portfolio. Is Target Hospitality a ground floor opportunity to own a key supplier for America's multi-trillion-dollar infrastructure supercycle, or is it a speculative blueprint with too many potential cracks in its execution plan? The foundation is solid and the frame is going up, but the heavy lifting has really just begun. The potential reward here is substantial, but so is the structural risk. Do your own due diligence.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.